Canada's economy is starting to crack. Here's why.
This chart shows the headline equity market holding remarkably flat, even as trade disruptions and global conflicts escalate. While the index remains stable, individual sectors are diverging. Right beneath the surface of the broader economy, invisible air pockets of financial risk are forming. High-performing tech and energy stocks are currently propping up the overall averages. In sectors like private credit and commercial real estate, however, the underlying data is deteriorating. Because the headline index looks calm, investors are flying into a tightening credit environment, sustained almost entirely by this false sense of stability. The Canadian housing market has become a primary site for these air pockets, specifically the pre-sale condo sector. Buyers who purchased units at the market's peak in 2021 are now reaching completion, only to find final appraisals coming in hundreds of thousands of dollars below their original purchase price.
Who's really responsible for this situation?
To prevent a wave of defaults, banking regulators have adopted a don't ask, don't tell policy regarding these shortfalls, allowing lenders to utilize what are known as blanket appraisals. This illustrates how a blanket appraisal functions. A buyer committed to a $1 million purchase at the peak, shown in blue. Today, the unit is worth $800,000 in red. Through a blanket appraisal, the lender ignores the $200,000 gap and issues the $1 million loan anyway. This pattern of ignoring losses extends into subprime corporate credit. Shares of lenders like GoEasy recently fell 57% as the company suspended its dividend and reported surging losses on its loan books. The financial system is now trapped in a loop of pretend and extend, with lenders relying on the hope of imminent interest rate cuts to keep these underwater assets from collapsing. While local markets wait for cheaper credit, a geopolitical shift in the Middle East is destabilizing the trade routes the global economy depends on. Conflict near the Strait of Hormuz has turned the world's most critical energy choke point into a zone of extreme volatility. Closing these shipping lanes does not only delay cargo, it forces complex physical refineries to halt operations entirely. These refineries require continuous flow to function. Because they lack unlimited on-site storage, a blocked port forces a shutdown that can take months to safely reverse, destroying immediate global supply. This physical destruction of supply ensures a wave of inflation that cannot be reversed by simple central bank policy. The energy shock in the Middle East has immediately impacted European natural gas markets, where prices have nearly doubled since the end of last year. This chart connects the energy spike to the global food supply. Natural gas is a primary input for fertilizer. As a result, the cost of ammonium nitrate out of New Orleans has increased by 70%. Policymakers face a fundamental paradox. Raising domestic interest rates cannot lower the global price of a barrel of oil or a ton of fertilizer. If they keep rates high to fight this energy-driven inflation, they risk a total collapse of the underwater housing markets and fragile private credit sectors currently holding the economy together. Central banks are in a no-win scenario, forced to choose between preserving the financial system or allowing the cost of living to reach unsustainable levels. The historical playbook suggests an inevitable outcome. When forced to choose, governments generally move to save the financial system through rate cuts and intervention. This diagram shows the mechanism of a bailout. Central banks engage in quantitative easing, purchasing toxic debt from commercial ledgers with newly created reserves, propping up equities by flooding the system with liquidity. While these moves save the economy on paper, the physical cost of living remains disconnected from the financial recovery. The ultimate result of this pretend and extend economy is a permanent wave of global inflation, a cost that every citizen will eventually be forced to pay.